Imagine for a second that you are just looking out at the ocean.
Okay.
And you've got all these novice surfers out there, right? They're splashing around, just exhausting themselves trying to catch absolutely every single ripple that comes their way.
Yeah, just completely frantic.
Exactly, frantic. But then way out back, like deep underwater, you have the whales.
Right.
And they aren't splashing at all. They're moving staggering amounts of water, quietly shifting the entire current of the ocean, just waiting for the perfect moment to surface.
That is a really powerful image.
Right. So welcome to this deep dive by MyCryptoParadise. Today we are unpacking a really fascinating blueprint from a master trader on our Paradise team, Simon. We're looking at how the market quietly hunts the overleveraged.
Yeah, and I think the contrast between the splashing surfers and the quiet whales, it perfectly captures the market environment we are analyzing today.
It really does.
Because right now, Bitcoin is hovering dangerously around that critical $74,700 mark. But Simon's analysis isn't just, a standard technical price update.
No, not at all.
We're actually exploring the underlying psychology, the defensive tactics, and really the professional frameworks that separate true market veterans from gamblers.
Exactly. And Simon has basically issued a flashing red warning at this 74.7K level.
He really has.
He's noting that the market is actively hunting liquidations.
Yeah.
Like the data shows this incredibly dense cluster of overleveraged short positions sitting right at this exact threshold.
Just waiting to be trapped.
Yeah. People have borrowed heavily against their portfolios and now they're stuck. But I want to ask you, what is the behavioral science behind putting yourself in that incredibly fragile position to begin with?
Well, it really comes down to the dopamine loop of immediate gratification.
Okay, dopamine.
Right. Human brains are naturally wired to prioritize short-term rewards over long-term compounding.
Yeah, we want it now.
Exactly. A retail trader looks at their account balance and the prospect of growing $1,000 safely over, say, a 5-year horizon, well, it feels painfully slow to them.
Yeah, nobody wants to wait 5 years in crypto.
Right. So the market steps in and offers them leverage. It gives them the ability to borrow capital to multiply their exposure.
And that's where the trouble starts.
Absolutely, because the temptation to turn that $1,000 into $100,000 overnight, it completely overrides their risk management.
Wow.
And that psychological vulnerability is exactly what creates the conditions Simon is tracking.
Okay, so they use high leverage and they bet the price will go down. They short the market.
Yes.
But let's look at the actual mechanics of what happens when that trade goes wrong.
This is the brutal part.
Right. Because when the price starts moving up against them, the exchange's risk engine, it doesn't care about their feelings.
No, it doesn't care about their technical analysis either. The algorithm is entirely ruthless. When an account's margin threshold is breached, the risk engine just automatically seizes control of the position.
It just takes over.
Yeah. And to close a short, the system must buy back the asset. So the algorithm fires off an automated market buy order.
Wow.
And it consumes the closest available sell orders on the order book without any regard for price efficiency. It just buys.
And that creates a chain reaction, doesn't it?
Absolutely.
Because that automated market buy order consumes liquidity, which pushes the current price up just a fraction of a percent.
Right.
But that tiny tick upward is enough to breach the margin threshold with the next overleveraged trader in line.
Exactly. Their account gets seized, another market buy order fires off, and the cycle just accelerates.
Domino effect.
Yeah, that is the literal mechanical definition of a liquidation cascade.
Yeah.
You have thousands of positions being forcefully closed by a computer, creating this cascading spike in buying pressure.
Man, that is wild. So the crucial takeaway from Simon's analysis here is that this creates an illusion of demand.
Yes, exactly. An illusion.
Because the price isn't rising, because institutional players are super eager to accumulate Bitcoin at $74,000.
No, not at all.
It is rising purely because trapped participants are being forced by an algorithm to buy back their losing bets.
That's spot on. And you have to ask, if the upward momentum is entirely artificial, if it's driven by a computer squeezing out over-leveraged shorts, how long can that illusion actually last?
Right.
Because to the untrained eye, a green candle is just a green candle.
Yeah, retail traders just see the price going up.
And then FOMO kicks in, the fear of missing out, and they start buying what they think is a massive breakout.
But it's a trap. And this is where Simon's methodology moves past standard price charts, right? He looks at the underlying order flow.
He does. He is analyzing volume footprints and the tape.
Right, the tape.
And since early April, the price action has printed higher highs and higher lows.
Which looks great.
Right. Textbooks will tell you that signals a strong bullish trend. But the internal data tells a completely different story.
Because of the volume disconnect.
Yes, the volume disconnect. Simon's data highlights that while the price steadily climbs, the actual buying volume, the genuine participation of real capital moving into the asset is actually steadily decaying.
Okay, wait, hold on. Because I am looking at the data right now, and the order book is completely stacked with green buy orders just below the current price.
Yep.
It looks like an absolute fortress of support. So how can participation be dropping when there are literally millions of dollars in buy orders sitting right there, visible to everyone?
Because the order book only shows intent. It doesn't show execution.
Oh, interesting.
The difference between the order book and the tape is paramount here. The tape is the permanent record of trades that have actually occurred. It's the receipts.
Right, the actual money spent.
Exactly. The order book is just a menu of what people claim they want to do. And that discrepancy is exploited through a tactic called spoofing.
Placing fake items on the menu.
Entirely.
Yeah.
Smart money places overwhelming limit buy orders just below the current market price. And to a retail trader, or even to a basic trading algorithm, that massive wall of bids looks like unbreakable support. It creates this psychological safety net.
Right. The retail trader thinks, look at all these buyers, the price can't possibly fall.
Exactly. So they execute a market buy order, purchasing the asset at the current high price.
But the whales who place those massive bids on the order book, they have zero intention of ever actually buying.
Zero. None at all.
Wow.
The moment the price starts to drift downward toward their bids, they simply cancel the orders. The safety net just vanishes.
It just disappears.
Yeah. The entire purpose of spoofing those bids is just to manipulate the retail trader into feeling confident enough to buy.
But why? Like, why go through all that trouble just to trick retail into buying?
Because whales need an exit liquidity strategy. Think about it. If an entity is holding tens of millions of dollars in Bitcoin and they want to secure their profits, they cannot simply hit the sell button.
Right, there wouldn't be enough buyers.
Exactly. A market sell order of that size would chew through the available liquidity, collapse the price instantly, and literally destroy their own profit margin.
So they have to distribute their holdings gradually.
Yes. They need a continuous stream of optimistic buyers to absorb their selling pressure without tanking the chart.
Man, so they distribute their heavy bags while simultaneously making the market look strong. That is brilliant, but also kind of terrifying.
It really is.
And Simon also connects this fragility to perpetual futures funding rates, right? Let's break down why an extremely positive funding rate acts as a glaring vulnerability.
Sure. So perpetual futures contracts don't have a settlement date, right?
Okay.
So exchanges use a funding rate mechanism to keep the futures price tethered to the actual spot price of Bitcoin.
Right, to get them aligned.
Exactly. When the funding rate is highly positive, it means the market is overwhelmingly skewed toward long position.
Meaning everyone expects it to go up.
Right. And the people betting the price will go up are literally paying a fee every 8 hours to the people betting it will go down just to keep their positions open.
Wow. It completely shows their hand. It broadcasts to the entire market that the boat is just completely tilted to one side.
It does. And smart money looks at a highly positive funding rate, and they see a top-heavy, overconfident, and highly leveraged retail market.
Right.
Add in the fact that the underlying buying volume is dead, and the support on the order book is entirely spoofed. Well, the foundation is hollow.
So the trap is set.
Mm-hmm.
The retail traders are paying premiums to stay long. They feel safe because of spoofed buy walls, all while the volume is quietly drying up.
Yes.
So what's the trigger? How does the smart money actually capitalize on this hollow foundation?
They initiate a concentrated burst of selling.
Just a sudden dump.
Exactly, just a sharp, targeted push downward. And because the market is so top-heavy with leveraged longs, that small push breaches the margin thresholds we discussed earlier.
But this time in the opposite direction.
Yes. It triggers a cascade of long liquidations. Those seized accounts are forced to market sell. Panic sets in, the spoofed buy orders disappear, and the price just plummets into an empty order book.
And the smart money profits from the resulting crash.
Precisely.
Okay, so if smart money is artificially propping up the market with fake orders and preparing to pull the rug, How does a trader mathematically measure the exhaustion of that upward move?
That's where indicators come in.
Right, because Simon brings up the bearish divergence on the 4-hour RSI, the relative strength index.
Yeah, that's a key metric for him.
We have higher highs in price, but lower highs in momentum. Let's explore the physical causality behind that indicator.
Absolutely. So the RSI measures the speed and magnitude of recent price changes.
Okay.
When you see bearish divergence, it means the physical force pushing the price up is deteriorating. Every new push higher is being achieved with less capital and less enthusiasm than the previous push.
Okay, I love the analogy Simon uses here. He uses the analogy of a car driving up a steep mountain, which illustrates the physics perfectly.
It really does.
Because if you are only tracking the car's elevation, which is essentially the price chart, you see it moving higher and higher, it looks totally successful.
Right. From the outside, it looks fine.
But if you look at the gas gauge, it is entirely empty. The engine is sputtering, the car is still creeping upward, but it is moving purely on leftover inertia.
Yes.
It is a mathematical certainty that gravity will eventually overwhelm that dying momentum. The car will stall, and it will begin rolling backward.
That is a perfect way to visualize it. And that physical momentum translates directly into the structural architecture of the market.
How so?
Well, Simon utilizes Elliott wave theory to map out these shifts in mass psychology.
Right, Elliott wave.
The core premise of Elliott wave is that markets are not random. They move in fractal wave patterns that reflect the natural oscillation between optimism and pessimism. He describes the market as a breathing organism. It inhales and it exhales.
Okay, so where exactly are we in that respiration cycle right now, according to the data?
Simon identifies the overarching macro trend as bearish.
Bearish, okay.
Yeah. He actually distributed his own holdings at significant highs around the $121,000 mark, anticipating the shift.
Wow, perfect timing.
Very precise. And the current price action, this slow, low volume crawl upward, he categorizes that in Elliott wave terms as a double three corrective pattern.
So what does a double three actually look like on the chart, and why does it signal an exhale?
A double three is a complex, overlapping structure. Instead of a sharp, aggressive impulse wave driven by genuine demand, a double three looks choppy and sideways, just sort of slowly drifting upward.
Sounds sluggish.
Very sluggish. It's composed of two smaller three-wave corrective patterns linked together, and it signals an exhale because it isn't driving a new trend.
Okay.
It is simply relieving the oversold conditions of the previous drop. The market is taking a shallow, exhausted breath out, resetting its indicators without attracting any real volume.
And because the macro structure remains bearish, that shallow exhale precedes the next major inhale, which Simon projects to be heavily downward.
Yes, that's the expectation.
In fact, he is targeting the $44,000 region, which explains his statement that breaking the $76,000 resistance level is a low probability event.
Exactly. And he isn't guessing or relying on, gut intuition.
No, it's all data.
The volume decay, the spoofed order books, the heavily positive funding rates, the bearish RSI divergence, and the overlapping double three wave structure, all of it points to structural exhaustion. The data dictates the probability.
But here's the thing. Recognizing all of these technical warnings, the spoofing, the bearish divergence, the wave structures, it's completely useless if a trader lacks the psychological discipline to execute based on that data.
That is so true.
Understanding the mechanics is only half the battle. The other half is the professional mindset.
Mindset is the true differentiator. Simon's core philosophy, which really drives the whole MyCryptoParadise methodology, is the absolute preservation of capital.
Defense over offense.
Always. Defense must precede offense. Amateurs, they operate with this overwhelming bias for action.
Yeah, they constantly want to be doing something.
They feel an intense psychological need to be in a trade at all times. If the market is open, they feel they should be exposed to it.
It is the fear of missing out.
Yeah.
It drives them to force mediocre trades in a choppy, manipulative environment just to experience the dopamine hit of participation.
Exactly.
But Simon operates on a starkly different paradigm, specifically utilizing the 80-20 rule, or the Pareto principle.
Yes, the application of the 80-20 rule to trading is profound.
It really is.
Simon derives 80% of his annual profits from merely 20% of his executed trades.
Just 20%.
Yeah. He willingly sits out of the market, observing the chop, completely unfazed by missing a minor move.
Let's put some concrete math behind that discipline, because the impact on a portfolio is just staggering.
Okay.
Imagine an amateur taking 100 trades a year in this choppy, artificial environment.
Right.
Even with a 50% win rate, the constant slippage, the exchange fees, and the stress of managing highly volatile, low-probability setups, it just slowly bleeds their account dry.
It's death by 1,000 cuts. Furthermore, the mathematics of drawdowns are merciless.
Oh, absolutely.
If an amateur forces trades and suffers a 50% loss of their total capital, they do not need a 50% gain to recover.
No, they need a 100% gain just to get back to break even.
Exactly. By dodging the medium probability setups, Simon completely sidesteps those catastrophic drawdowns.
He acts like a professional poker player at a high-stakes table.
That's a great analogy.
Right. The amateur at the table gets bored. They want action, so they start playing weak hands, slowly blinding out their chip stack.
Yeah, just bleeding chips.
But the professional will sit there for hours, folding hand after hand after hand. They preserve their stack, they analyze the table dynamics, and they just wait.
Very patiently.
And when they finally receive a premium hand,
Yes.
and the mathematical odds are undeniably in their favor, they strike with full sizing.
That sniper mentality dictates exactly how Simon deploys his tactics. And bullish and bearish strategies require different temporal approaches.
How so?
Bullish tactics are fundamentally designed to catch bottoms. You wait for the selling pressure to completely exhaust itself so you can accumulate at a massive discount.
Right.
Bearish tactics, conversely, are designed to catch tops.
You wait for the car to completely run out of gas at the peak of the mountain before placing your bet that it will roll backward.
Precisely. And because the macro architecture remains bearish, Simon is exclusively deploying bearish tactics right now.
He's just waiting.
He is waiting patiently for this low-volume artificial rally to reach its absolute structural limit.
Right.
He refuses to enter a long position here, even if the spoofed order books manage to drag the price up another $1,000, because the risk-to-reward ratio is entirely asymmetric against the buyer.
So how do we synthesize these intricate mechanics? I mean, the liquidation algorithms, the order book spoofing, the wave theory, and the mathematical discipline. How do we turn that into an actionable framework?
Well, Simon actually uses a specific mental affirmation to anchor his execution in this chaotic environment.
I love this part.
He states, "Thinking probabilities, not emotions. Losses are feedback that sharpen my strategy, and wins are the result of disciplined execution."
That framework completely strips away the illusion that the crypto market is some magical venue for overnight wealth.
It really does.
When you understand the mechanics we unpack today, a very stark reality emerges. The market is a highly optimized algorithmic engine designed specifically to transfer capital.
A wealth transfer machine.
Exactly. It moves wealth away from impatient, over-leveraged participants driven by emotion and transfers it directly to patient, risk-managing professionals who strictly adhere to underlying data.
And that priority must always be defending your capital against these structural traps before you even attempt to capture a return.
Right.
You have to recognize the illusion of strength before it consumes your liquidity.
Awareness is the ultimate defensive mechanism.
It really is. Recognizing the discrepancy between the tape and the order book, or the divergence between price and momentum, gives a trader the ability to step back and simply refuse to participate in the trap.
As we conclude this deep dive into Simon's analytical blueprint, there is a fundamental question that you should carry into your very next market interaction.
Absolutely.
The next time you find yourself staring at a rapidly ascending green candle, feeling that sudden, visceral urge to execute a trade because the momentum just feels unstoppable, pause and ask yourself,
Just take a breath.
are you deploying capital based on cold, high-probability structural data? Or are you just blindly splashing around providing the essential exit liquidity for a whale who is quietly swimming in the exact opposite direction?